There we go. So I'm gonna send some guys a link. Live streaming. Invite people. Copy. Right. I was just looking at it. I marked it LTC. Okay. This page, this isn't the page you're looking for. Nico, that page doesn't work. Let me look at it on screen here. Let's copy that. Forgot you guys can't see my screen when I open these, but let's have a look. So you're looking for it to, for this to be a wave 2 and then roll over. Okay, that's interesting. But you see the 89 to 90 area. That's what I'm gonna have a look at now, and we'll see whether we can get there first. Right. So Light's looking at. Let's get rid of this. I'm not sure why I drew that. Let's get rid of this. So Light was looking at this being some sort of 1, 2, 3, 4, 5 in there. On a daily, it doesn't tell us anything much. But what we can find on a daily is that this didn't take the liquidity at the order block here. Stopped at the OB, and besides being the order block, this was also a broken high here and here. This was the fair value gap in here, so this was where your setup needed to be. And if we didn't take liquidity in here, that means that this was just a retracement to head higher. It wasn't a reversal, because you can see we didn't take the liquidity below the order block here. So which means this probably heads higher, Nico. And if it's heading higher, then we'll talk about what Sloth and Agua and I talked about the other night in terms of a model. And we'll tackle all of that now. Yeah. So let's just talk about that, right? So for the zoom model that we do, right? And I'm going to try and find an example for you. I can see something on LTC here, so we'll just use it as this at the highs. So with the zoom model, whether you're bearish or bullish, the model is we have and you look for these at points of interest, key points of interest, premium and discount areas of the range, all highs and all lows, right? Where if this was a high here, so we have the first run up, which is your accumulation. You have the run down, a retracement, which is a failure swing. Failure swing because it fails to take this low out. And then you have an open liquidity run up this way, which takes the high, right? So this is a liquidity run. We consider this first high of the accumulation phase to be the real high in the market. And then the open liquidity run is the one that takes the liquidity of this high, people putting their stops above here, whatever it is, right? You are only interested in being bearish once you see a shift in structure. Now what we've been taught is that, let's just do this for now, we've been taught and told that once price breaks through here and all low, that's a break of structure, right? You agree with that? That's what they tell us, which is not entirely incorrect. But what we are trying to do with our models is try and find instances where we can enter earlier and anticipate that it's going to break structure here. So this is like almost a guaranteed break of structure here. But what we are interested in is where can we find early market structure shifts? Now, last year I gave you guys in the Discord, if you look, well, we did 2 lives or 2 or 3 lives, and in the Discord under PA patterns, I posted a series of candlesticks which I did for you guys. Let me see if I can paste it up here. Right, this was a series of candlesticks here, and this was how we can basically figure out when early market structure shift happens. So in the first instance here, you always look for the fair value gaps. The down candle here is your order block. As soon as price trades through it, it validates that candle as an order block, but it's not a market structure shift. The market structure shift occurs above the FEG. So here, so you could buy the next candle that closes above the FEG, or you could wait for some sort of retracement and then take it up. So this is order block validated before the market structure shift. Here you have order block and market structure shift together. On this green candle up here in the middle one, your order block was validated and price closed above the fair value gap. So you have both happening there. And here you have a market structure shift first, and then your order block is validated. So in both instances, you could, we wouldn't want to necessarily buy, this one on the, although it's a market structure shift, we'd wait for at least, because this down candle here, the order block is pretty huge, anything above the 50% we'd consider order block validation as well, right? Its price trades through 50% of the order block. So these are the 3 instances that you would need to remember. Order block validated before market structure shift, order block and market structure shift, and then market structure shift and then order block, right? And you'll see where it all comes into play now. So this is called the zoom model. So we have the accumulation, a failure swing, open liquidity run, a push down which breaks through the failure swing. That's key, right? It has to break through the failure swing or it's not a zoom model. Let me just get back into the live chat here. Give me a second. Right. So it has to break through the failure swing for it to be bearish, right? And that's where the break of structure part comes. But within here at the top of the open liquidity run, we can sort of detect a market structure shift happening up here and enter early. And we're going to use a secondary model, which is the ICT 2022 mentorship FEG model to overlap with it, right? So what usually happens then, once you get the break of structure, what do you guys see? You see that buy side was taken, sell side was taken on the break of structure, which leaves us with the dealing range here, right? That's your dealing range now. Buy side taken, sell side taken. You are only interested in prices in premium here. Any premium FEGs, order blocks. So we could have an FEG in here, for example, something in there. We could have the order block all the way up here. We could be interested in that there. Order block, FEG, anything above the 50%. Even if it could be a situation where it's slightly below the 50%, but the FEG's there at the 50%, right? So we would consider that as well. Now with the zoom model in particular, what we also want to look at is the real high in the market would be the last up candle here, right? If this was the last up candle here, we're interested in the open price of the last up candle and we take it across in time. Let's do that and that. And you could mark the top off as well, right? So this entire zone here now becomes an area of interest for us. So extra confluence for you to add when you get an FEG forming around here and you start to see order blocks form here as well. So we would then be interested in price to retrace above 50%, and then we'll be looking for short entries and then another market structure shift. Remember, if we take anything in here, the stop's always going to be above the high because that's where the invalidation is. If you are bearish, then you don't want to see price go above the highs. And what I found out the hard way recently is if you are trading forex pairs, indices, please account for the spread. So don't just leave it a few ticks above the high, account for the spread and give it a bit of a comfortable buffer there. And then once we do that, then we're looking for the push down, right? So this is what the bearish zoom model would look like. And then you'd find instances where if this becomes inducement liquidity, there are at times, if the push here or the retrace here did not tap the order block, you'd find instances where price could return to the order block, and then you see even more speed afterward because the retracement high would act as inducement here, right? This would act as an inducement high, but the general model or consensus here is we have the accumulation phase, the failure swing because it failed to break the low, an open liquidity run, the push down breaks through the failure swing, which is the key. It creates the dealing range like I have marked off here. We look for the retrace and then continuation. Now if we had to put all of this together, you would just inverse this for the bearish side of things. If we had to put all of this together, let's shift this over here. Let's shift this guy here. We'll shift all of this over here, right? Let's get rid of that. Pull this guy here. Pull this guy here. Sorry, that guy there, and this guy somewhere here, right? If we had to put all of that together and we had to look at any, this is obviously cherry picking and back testing now. Let's look at LTC in particular. We would look on a particular time frame. Now, here's what we're gonna do here now, right? This was the high before the open liquidity run. So you can already start to see the pattern happen here where we had an accumulation phase. We had a failure swing. We had an open liquidity run here, which took the high off there, right? We considered this to be the real high in the market. Then you had a push downward, which broke through the failure swing. So what did that in essence give you? It gave you a dealing range. Wherever that starts to end will become your dealing range. And all we are interested in then is what are our points of interest, right? First point of interest obviously is we would use the open of the highest up closing candle before the liquidity run, which is there. Now you could take this as well, just for extra confluence, right? But let's just consider it the open, right? Because we're also interested in our entries forming around the open when price returns to it. The other area of interest is your last up closing candle here. So you would call this your order block, right? Just the wick on that one. Any FEGs that form inside here. Now, if you notice here, this is a daily time frame. We don't have any FEGs that are formed inside here for us to use the market structure shift model. When you get an instance like that happening, where you had no FEGs forming on this side, and the FEG cannot form in the actual last up closing candle or the order block. So it'd have to be anything before that. So you don't want the FEG forming in the order block. It has to be candles before the order block. So in this particular instance here, what you actually see was price did this, it retraced, and then it shot up, right? Which means this low here is the low of interest for us, right? There's it here, this one. Now, if this was the last up closing candle before this liquidity run here, then we are interested in the opening of the highest up closing candle here. That would serve as a confirmation in a market structure shift when price closes below the opening of the last up closing candle. So if you have a situation where there's no FVGs forming, you would use the open of the last up close candle as confirmation for your market structure shift. So here on this side, as you see, there's no FVGs forming on this side. The market structure shift on a daily would actually be there then, right? Opening of the last high or the highest up closing candle. Now if we went down lower, you probably could find something better here. So maybe on the daily it's not ideal, but let's use the daily as an example, right? We also in this case have the fair value gap created by the break of structure. So what happens is, like I said, in this situation you had price moved up, price retraced, and price moved up again. Price moved up, price retraced, price moved up again. You have a situation on the lower time frame where this particular candle here was the candle that retraced to rebalance any FEGs that formed inside there. We are interested in that candle's low because the candle low that has retraced and filled imbalances becomes a short-term low. When price trades through it and leaves an FEG behind, we are interested in that FEG to be our entry. Now there's going to be times where that FEG is going to pull back immediately, and I'll show it to you in this case, which it does. And there's going to be times where it's going to move away quickly, but when price comes back to it, that's going to be our entry. So with the 2022 ICT mentorship model, you can see the displacement happening in this down candle here. It created an FEG here. You guys can see that. That's the FEG on a daily. I'm going to pull this all, I'm going to pull it to here for now, right? You can see that the next daily candle pulled back into it and then price moved away. On a lower time frame it would look even better, but your entry is going to be here, which is coincidentally the order block as well. Can you see that? So you've got confluence there. Now let's go back in time and see what actually happens around this area here if we did get any entries. Nothing as yet, right? Nothing as yet. We would then move on to the second instance. Now remember, keep in mind market structure shifts. In fact, let's keep that FEG on there and we'll take it off in time just now. Whenever you get a low being broken, right? Say this one and this one, with a fair value gap inside it, the candle that breaks the low that leaves a fair value gap, or the candle that breaks a high and leaves a fair value gap, in this case the candles that break a low that leave a fair value gap become what we call fair value for selling in this case, where in this candle there are willing buyers here, but no buy side delivery was offered here. It was only sell side delivery offered in this candle. You can see the candle was only down, no buy side was offered. So when price returns to that candle, there are going to be buyers inside here that are going to want to buy above the market price, right? Whether it's your breaker block, mitigation block, people coming out of longs that were trapped here, whatever it is, right? Or stops being hit. There are people that want to and needed to buy inside here, but no buy side was offered, only sell side was offered. So this becomes an area of interest for us, where if we mark it off, this fair value gap that broke through a low, a short-term low on this side here, becomes fair value for selling. Now if you incorporate breaker block inside it, which is the actual down candle that broke a failed order block, which is this one in this case here, then you'd realize that you have breaker block and fair value for selling occurring in here. When price returns to it, we're looking for sells, right? You see that? Does that make sense? Right? I'll take that as a yes. So,
Yes, sorry, I've got a barking dog in the back, so I'm gonna
yep,
be
no stress,
muted.
no stress, no stress. The only two models I'm going to talk about here, which would basically be the only two models you are going to use, would be our existing Zoom model and the ICT 2022 mentorship model that uses FEGs, right? Now, I'm just trying to explain there's an overlap of the two models. In this case, see the red line we have marked off here? Here's the red line we have marked off here, right? This red line here, which was the opening price before the liquidity run, the highest closing up candle. We took the open and we marked it off in time. Let's go and look because we know we want our entry to form around there. There's also a displacement candle here that broke through a low or lows. Previous candles that retraced to rebalance FEGs. So we're interested in the candle that broke those lows. That's the FEG here. There's the opening of the highest up closing candle here. Look at this. Can you see that? Also, what you need to be mindful of is are the candle bodies respecting the FEG? They are, right? No closes above. You become less bearish in these situations when price starts to close above your FEGs. In any case, because if we put the sense of it together, once you start closing above FEGs, what is that actually telling you? It's telling you that there's a market structure shift. Let's take this for example. Here's an FEG here. Here's an FEG here. Price is now closed above the FEG here. Are you still going to be bearish or are you going to be a bit more cautious on that one? There's clearly a market structure shift according to our models that has occurred here. Coupled with the fact at the bottom here, this was the real low in the market, the opening price of the lowest closing down candle. There's an FEG here, price closed above, so we validated the order block. There's the FEG, price closed above the FEG. This candle is the buy immediately if you're not willing to look for the retrace, right? Now on lower time frames, you could have gotten a buy in here because the daily is, we're looking at big swing positions here. We had a situation in here, probably on this candle here that broke the FEG, where there would have been on a lower time frame and another FEG in there. And let's just go down to a 4 hour and have a look if there was actually something in there. Right, it becomes a bit clearer on a 4 hour. You can see price pulled back here, but let's look at it this way. We were bearish all this while. We had a down closing candle here. We had a pretty huge fair value gap here. You agree with that? That's pretty big. In cases where the fair value gap is big, or you would use 50% of the actual candle to confirm your market structure shift. So price doesn't have to trade above the entire thing. 50% above would be enough. So this is a 4 hour, refined now to a 4 hour. This would be your candle that you are interested in. Now we have a candle here next that broke a high. Where's your high? Look for your highs. It's there, right? That's your high that you were interested in, that price broke through. Did that candle or this candle before it leave fair value gaps? There's a tiny fair value gap in here. There. It did. Those immediately become fair value for buying. So when price comes back into it, you're interested in being a buyer there, right? Same story here. You had a high being broken here. The candle that broke it left a huge fair value gap there. When price returns or comes into the fair value gap, this is where you're interested in buying. This is the ICT 2022 FEG model. In the simplest terms, and not complicating it with all of our other zoom models and market structure shift models, is the candle that breaks a high that leaves a fair value gap. The fair value gap becomes what we call fair value for buying in this case, because this is a bullish order flow. Order flow is bullish. The fair value gap, or the gap or imbalance that is left behind after breaking a high, becomes fair value for buying. Can you see that? Now we would only be interested or not be interested if price started to close below the fair value gap. Then we would look for anything at the lows, right? So important model, the 2022 mentorship model, because what's going to happen is you are going to now start training to see with your eye instead of having to mark these off. So if I had to just take a look at any sort of market structure shift models, right? Let's look at something here. We have an FEG here, tiny FEG, right? Price pulled back in this particular case to the order block here, right there. We had a market structure shift because price traded through the low of the up closing candle here. This candle traded through. The second candle closed, so that confirmed the market structure shift for us, right? We would be buyers in this candle here, or this candle here. Now, say you missed that. What's your next entry? Your next entry is, if you are only viewing this as a down candle, what you need to start viewing this is as we had a price that moved up, we had a retracement, and we had another price that moved up. So we had price moving up, we had a retracement, price moved up, and then it broke through, right? It broke through. What does that give you? A dealing range. Buy side taken, sell side taken. You're interested in a retracement to any fair value gaps or points of interest above the 50% or in premium for you to short. Now, often what I would have done is I would have used the market structure shift fair value gap, or the fair value gap that led to the market structure shift, as a point of interest for me. When price returns to it, that's where I want to be a seller, because it's also at the order block, extreme order block, right? The last order block. In actual fact, your entire order block is the entire series of up candles. It's not just the last up candle, it's the entire series of up candles. So in this case, it would be there and there, right? Now, let's take away the order block thing and use fair value gap only. We had this displacement candle that I have this marked off here, which broke through a low here. This is the fair value gap that I'm interested in. Can you see that? Your stops are always going to be above the high. If you are more aggressive, your stops are going to be above this candle high or above 50% of this body. But can you see price broke through, traded back into the order block, which is fair value for selling. Only sell side was offered in here. Liquidity was taken here. Now, price would return into here because people who longed down here need someone to sell to. Who are they selling to? People who are willing to buy in here, because only sell side was offered, no buy side is offered, right? So makes sense. Fair value for selling inside the FEG. Price returns to the FEG once, twice. Another market structure shift inside here. Now look at this one, right? We had a market structure shift inside here that gave us the same model. What is the model? FEG here. This is the candle that broke through lows here. Take it across. That's your entry. See there? You had another market structure shift here, or lows that candle that broke through lows there. That's another entry there. Can you see how, if you are bearish, all you are interested in now is which are the candles that broke through lows, and how can I enter? If I am bearish, order flow is bearish, then I'm only interested in entering on retracements into FEGs. So if we had a candle here and a candle here, you'd notice that these candles would leave wicks behind in the terms or in sense of price came into it and then went down, came into it and went down. This is where we want to be buyers, because what these wicks actually are is price went down, price retrace, price went down, price retrace, price went down. That's what you have to start seeing the wicks as. Wicks are retracements. Retracements back into the FEGs is what we are interested in. So if you are bearish, then you'd be looking for FEGs to get, so this candle in particular here broke through this low here. There, you are a seller in that FEG with your stops above the highs here at the previous FEG. Right? Simple as that. If you take it one lower, there's a FEG of a candle or series of candles that broke through a low. That's your FEG. That's where you're a seller. Right? Look at all of them. FEG on a series of candles that broke through a low. That's where you're a seller. You would continue to do that until you start to see a market structure shift. And where is the market structure shift? You are wrong when price starts to close above your FEGs. So in this case here, we had an FEG. We were looking for price to head down lower. Let's not take into account that this move down took liquidity here, right? If we didn't take that into account and we said I want to be a seller in here, then we would have got stopped out here, right? Because price closed above the FEG. This became a market structure shift. The model is as simple as that. You are bearish as long as the order flow is bearish, and you are a seller in the FEGs that broke through lows. Does that make sense? Sorry, I'm just drinking some water. Where are these guys typing? You can type in the live chat for the other guys, the rest of the guys. Right, so we are overlapping a Zoom model and a 2022 mentorship model, and I trust me, this is all you are ever going to need, because if you have this model, you're going to know when to enter. You're not going to be afraid of anything going against you. Your only other concern or only other thing you need to be aware of is this a retracement or is this a reversal? Now, the four tenets that make up or the four elements that make up price swing or price delivery would be retracements. Retracements seek imbalance. So if there was an imbalance in here and if this was a retracement, then we expect price to go higher here. We'd look for any imbalances created in there for price to go higher. Reversals of order flow. So this was down. Reversals seek liquidity. Liquidity are found below all highs, all lows. Liquidity pools, right? So you can see price took it here, and that's why you had a reversal here. So this was a reversal. This here was retracement into an imbalance. So retracements seek imbalance and then continue. Reversals seek liquidity pools, all lows, then reverse. Expansions seek order blocks. So you're never going to find a point where price reverses from consolidation. It's almost rare, right? Price just suddenly reverses. But when it does, two things are going to happen. This price is going to seek an order block that was created here. Alternatively, price consolidation seeks equilibrium. So the equilibrium of this range that was created here, any pullbacks into there 50% of this range is going to become sensitive to price, and then we're going to shoot down there. So 4 things you need to remember: retracement seek imbalance, reversals seek liquidity, expansions will look for order blocks, so whether its price is expanding up or down, they will look for an order block, and consolidations would seek equilibrium. So if this, for example, was the range in here, as price broke through it, it retraced 50%, market structure shift, gone, right? If you are all happy with that, then we can now start to take entries, not just at highs and lows, but we can even shift to lower time frames and start to look for entries on all time frames. If you understand the concepts of what I've just said, price is fractal, you can start to take entries anywhere. Right, on a 15-minute, LTC was a bit ugly here, but you can see clearly market structure shift. There's your FEG here that led to the market structure shift. Here's your old open candle before the liquidity run here. You would then look back to any of your models to see where you could probably enter in here. In this particular one, on the 15-minute, we didn't quite get anything in here, but I think on an H1, I have this marked off for some reason, H1 or M30 or H1. Just have a look. H4. H4, right? Yeah. Now imagine you mark the time frame will dictate the range of the swing. Now we are on an H4 here. What do you think an H4 market structure shift gives you? It doesn't give you a tiny move, it gives you quite a decent move. So same story here. We had market structure shift at the bottom. Here's your 3-wave move to the downside. Break of structure above here or here, or change of character here, break of structure here, right? Here is the FEG. Let's get rid of this one. Here is the FEG that broke through the high here, right? It's that candle wick to there. I'm going to zoom in into that so you can see where I took it from. We took it from this candle low to this candle low here. That was the imbalance. This is where we want to be a buyer. And if you are a buyer in there, your stops are always going to be below the lows, right? In this case, it was a $4 stop here, right? Is there any other way that we could have entered into this knowing what we know? Yeah, of course. There's a high that price broke through that left an FEG behind. You want to be a buyer in there, right? But you want to see market structure shift occur because you are aware that there's a low here that could serve as inducement or liquidity. You want to see market structure. You don't want to be, we don't blindly buy down candles or FEGs. You want to see market structure shifting inside this. Unless you saw something else which was something like that, and that's a zoom model, right? Accumulation, failure swing, open liquidity run, push, retrace, continuation. Right? Easy as that. Look for the zoom models anywhere. Look for the fair value gaps left by candles that break through old highs, which are these. Market structure shift model again. There's more FEGs in here. There's another one in here. If you didn't catch any of, you didn't catch this one. If you didn't catch this one, then there's another one up here. FEG in here. There's another entry in there. Can you see that? There's never going to be a case or situation where you missed a move or you don't get entries. Now, coming back to LTC in particular, you can see that we've started to close above FEGs, even though, let's go to a daily again. we have all of this that happened up here, right? Price is retraced. We are now back into a zoom model in here. So, and we've touched the order block, if I'm not mistaken, here, right? We have, which means price can start to retrace. Where would it start to retrace to? Now, if this was, has this taken any liquidity down here? It hasn't. Could this possibly be a reversal? Highly unlikely, right? So this part here could then just be retracement. Once we start to see a market structure shift in here, we'd look for imbalances further down or liquidity levels, and what's lying below us, all the way below us here. What do we see? We see relative equal lows all up in here. So this is all of the liquidity or pool of liquidity lying below us. And we have the order block down here. So we'd look for price to then go from somewhere here, if it can give us, to somewhere down here to take the liquidity, right? What is this then giving us? Let's look at it on a larger scale. Accumulation, failure swing, open liquidity run, push, right? Now we're in bearish mode. We've broken below the failure swing, retrace to this level here, continuation. Can you see where the zoom model is everywhere? It's on the high time frame, low time frame, but now we're anticipating that if we were to look for this kind of zoom model, then we would look to see the failure swing being broken before we can look for the retrace areas of interest in order to send it down again. Right, having said that, let's look at a few other pairs. If you guys have any other questions, you can just type them to me on the live chat channel here. Here, type here. Can you see these are the only two models that we want to concentrate on? There's a ton of other models, but we'll get to those slowly as we go along, because those require being knowledgeable about time.
Yeah, can we take a look at Apple?
Yeah,
Poison Apple in here, because we swept liquidity, right? That 129.04 level was that important level I was planning on holding above because we swept liquidity, but higher time frame, it's still obviously a big bearish trend, right?
Let's take a look at that.
Yeah, 140, somewhere between 138 to 142, depending, is where I see areas of interest for to take profit on the long and to switch to a short position.
Yeah, so
unless we're gonna
it's an interesting point here where it's gonna be fun to see what the market open does tomorrow, right? I'll tell you why. When I look at NAS, now I can see Apple pushing higher, right? I can see it already, because here's your accumulation, here's your failure swing, here's your open liquidity run, right? I've already marked these levels that I'm interested in. There's the fair value gap here that led to market structure shift. It's an actual gap in price as well. The red line is your real low in the market, right? We marked that off. Here is your order block, or rejection block, whatever you want to call it in here. Right? This is where if we start to close above it, then I'd be even more bullish. I'm still bullish but I want to see price retrace and do this first, right?
Yeah, right. Exactly. Yeah.
I want to see it do this, and then I want to see it do this. Because what did this do for us or do for the market? It led people to believe that price is going up, and it left them behind. It's inducement. They've now aped in at the Friday's push up, and they've put their stops below here. They think that this gap is now filled or rebalanced because price came into it. Not the case. So I want to see price push down like this and then shift up. And when that does do that, what's on the market or what's on the menu? It's all of these highs to the left. Right up to there, at least. Right? Even higher probably. Probably take the highs, the liquidity. Because remember, let's look at this on a 4-hour chart. Remember, people who are longing down here are accumulating orders. They need to sell to people higher up, right? Remember a couple of weeks ago when NAS and S&P did whatever it did, it delivered price on that CPI move into a fair value gap. So let's put it all together now with what I've just told you. Here's a low that was broken by candles with a fair value gap where only sell side was offered. You agree?
Right, and that's the FVG that I'm looking to target
Correct.
eventually on the long and flip
Yeah.
to short, right?
So on a if we look at the FVG in particular, I would look at maybe this one here, right? It's a tough one. We could go here, right? Now
yes, exactly.
we want price to be delivered inside here because this area here is called fair value for selling, right? Fair value for selling. There are buyers inside here that never got the opportunity to participate because only sell side was offered here. So if the big guys are accumulating sell side liquidity here, they want to offload to buy side. Where's that going to happen? It's going to happen in here. It's going to happen at a place where no buy side was offered. If this is the market price, remember I said they offload to willing buyers above the market price. Where's above and where are the willing buyers? They're in here. They're in there because they never got an opportunity to participate, so they know they are willing buy. Sorry, I just have to mute someone. I think it's Al Dente. Al Dente, just do me a favor and mute yourself, brother.
Al
Dente. Okay. Where are the willing buyers above market price? They're in here. There's the fair value gap, ICT model, of the candle that broke through a low, left a fair value gap. This fair value gap did not offer any buy side delivery, only sell side. So it's sell side imbalance, buy side inefficiency, right? SIBI. Sell side imbalance, buy side inefficiency. So the guys that have long down here, they are going to look to offload not to the guys up here or up here or up here. No, the guys inside here. That's where they're going to offload.
Okay, perfect. Yeah, so I'm going to potentially hold on for some drawdown to 126.
I'll show it to you. Right? If you remember the NAS model that we looked at the other day, here. Let me get a cleaner NAS model. Uh, 30 minutes. Right, let's look at a 4-hour. Remember all this PA here? And then we had this huge spike up here at 12.2. Where was that offered into? It was offered into an area where there were willing buyers above the market price. Here, in this fair value gap here. On a 4 hour, I just want to have a look at this. There, can you see that? So same theory. When price is moving up and up, all they were doing in this area here was accumulating sell side. When I say accumulating sell side, it's a difference between taking sell side, right? Accumulating sell side is these guys here, all here, were driving price lower into the imbalances here. This huge imbalance here, right? That's one. And then the further one in here. They were driving price lower to accumulate more longs to willing sellers inside here, because only buy side was offered. So the ones that shorted here to offset their longs, they found people to sell to. Right, same story, right? So accumulating sell side, and then they ran price where? They didn't run price, they ran price to a place where there was liquidity. Now there's no liquidity technically up here or here, because this took this and this took this. So there's this, just this little bit here in the fair value gap there. Can you see that? That's where they took it to and they ran it. So same theory across anything that you look at. Where are they going to take it to? If they want to take it up, where are they taking it to? They're going to take it to a place where they know they are willing buyers above the market price. So if, sorry, in this case, yeah, buyers, right? They belong here. And this is not a case where this is a reversal. This is a case of distribution, right? They are already short through all of this. They're already short here. This is not a reversal in the market. No, they are offsetting longs, their shorts, by taking longs, selling it to people who are willing to buy it back, and then re-adding their positions in here to send it down again. Does that make sense? Slot, you get that? Al dente, the rest of you guys?
Yeah.
It's just distribution.
Yeah, so I just posted a quick chart in the boiler room. So this is going to be like Tesla, right? They're going to go for all of that liquidity there to the left, down to the 90s.
Yep.
That's going to be my target when I take a short
Yep.
after this long. So.
Right. So if we keep this in mind, because remember, in a downtrend, every retracement is just distribution, right? All of this is just distribution. In an uptrend, all of this is accumulation. This is accumulation. The retracements in an uptrend are an accumulation. The retracements in a downtrend are distribution. They already know the order flow. It's bearish. They are offsetting their shorts with longs to willing buyers above the market price to buy back their positions and send it down lower. That's just how it works. So we have to start thinking now, where's the liquidity? If we were on an even lower time frame, we know for sure that all of this is liquidity, right? We know for sure that there's liquidity here, 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 right? But there's also liquidities at old lows. Why? If we take into account a breaker block theory, this would be your breaker block. A low, okay, so this would be a mitigation block, in fact, here. There. Right? Failed order block. But coming from a point, let's call it a mitigation block. coming from a point where this failed to make a higher high, the order block failed, so they are trapped buyers inside there who are also going to sell or mitigate their losses when price comes into there. So you have a whole series of things here where order flow is bearish, trapped buyers inside here that want to sell. They are people who are willing to buy above market price because only sell side was offered, no buy side was offered inside here. So when price comes into here, it's going to start order pairing. It can take a while. It doesn't have to just come and shoot down. No, you're going to start to see it pair all the orders together here.
Yeah, I think earnings are on the 25th or 26th, so that might be our selling catalyst.
Yep.
Move up until then.
That's what you're going to see, right? So that's the theory behind everything. You have to start to think about it as offsetting. The guys that are short are offsetting their short positions with long positions here to willing buyers above market price so they can resell or re-short down. So that in this case, which is a bear market or bearish order flow, it's offsetting their shorts with longs. They don't want to lose money on any retracements. No, they don't. They're just offsetting. Right? That's what the theory or what you should be thinking of it as. Right, so that's Apple. Let's look at BTC really quickly, because I think BTC may be a little more weaker than we thought, right? And in hindsight, if we had looked at BTC the way we look at everything that we do look at now, it would have been a different ball game altogether, right? But it is what it is. I want you to start looking at all of this. At first, you're gonna want to draw the rectangles. But when you start to get really clued up with all of these things, you're going to start seeing them in terms of not needing to draw the actual rectangles. You're going to start playing it by eye, so to speak, right? Important thing to, and one of the things that I've heard a profitable trader speak about is that the market moves from breaker to breaker. Just understand, or just take that in. The market moves from breaker to breaker. It makes sense. So it would move from one breaker block to another breaker block, liquidity to liquidity, right? So once you start to get your model, depending on what time frame you use, whether you have one account that's swing trading, one account that's saving or allowing you to live off every day, and one account that you use to intraday trade, 3 accounts in total, the time frame is relevant. So in this case, if I had here, there's a low being broken that left a fair value gap behind here to here. I know however many days it takes to come back there, I'm going to be a seller. I'm a seller inside here, and my stops are my aggressive stop is above here, right? That's just how it is. Go back and start testing all of these theories. Once price starts to break below all lows or above all highs, the fair value gaps that get left behind become fair value for buying or selling. So if we had to take that into account, we could say that when BTC finally decides to turn around, that all of the offset positioning that happened down here, same as Apple, if you think about it, they are going to start targeting all of the imbalances where there's fair value, where they know there are willing buyers above the market price. So again, this is the market price. Anything above here is above market price. There are willing buyers inside here, and definitely inside here. So we know once BTC starts to take off, whether it does this and then does this, those are going to be our targets, right? Old lows, breaker block theory, all of the good stuff.
So for Bitcoin above that highest FEG, is all that price action then to the left considered like a balanced price range on a super high time frame, and we
Yeah, it's
shouldn't?
balanced. All of this is
No.
balanced. This is all balanced. All of this is balanced here. All of this is balanced, right? What's not balanced, and what you could consider, maybe it's balanced because you had all of this PA here, right? Even up to here, you could consider all of this balanced. So there's nothing, it's maybe the reason why Bitcoin didn't go up to this FEG here. It could be that the FEG was a breakaway gap because we had all of this price action inside here, right? This move down here up to here. So everything, let's mark it off here, right? Let's mark it off. This was the low. Anything above it is balanced. How's that? Right? Let's take this out. Everything above that is balanced. Meaning there was enough price action up and down through this entire range, even though you see a fair value gap here, that it didn't need to come to that fair value gap. Does that make
Also,
sense?
if we look at that long wick, right, that runs through the dotted red line,
Yes.
and then the body of that candle
Yes.
proves that.
Now,
That's similar to that ICT 4
yes,
hour
it's a
video you
balanced
had sent,
price
right?
range because most people only see wick down here, then candle body higher, price went down, and then another wick on this side. No, that's not what it is. If you saw the video that I showed you, let's zoom into this little piece of
Right, because
PA.
that's our wall
Yeah,
now, right? We
right?
shouldn't go above that
So
anytime
this
soon.
wick down, right? Price wick back up, opened here, went down, opened up here, retraced back into this wick here. So all of this here, right? Now, you are just seeing wicks and whatever it is, but what it actually is let me draw it out. Price went down, retraced higher, went down again, retraced higher, went down, retraced a little, and carried on going down. So this is what you're seeing here, right? That's what you're seeing, which means this is already a balanced price range. All of this is balanced. It means that this area here is a brick wall. So we have the low marked over here. We have all of this area in here. All of this price action. We have a breakaway gap in here. It broke through an old low. On a small time frame, there's probably an FEG inside here. But this entire range is balanced. This is also balanced inside here, which is why this is a brick wall. Let's mark it off. Here to here. We have to start worrying when we get above that now. Which makes me, yeah, which leads me to believe that I don't think we're gonna. I wanted BTC to come this high initially from down here. You'd remember me saying come to this FEG inside here, which was the market structure shift. But that could just be a breakaway gap inside here, right? So we'll take this off for now. I think we have the zoom candle that I've marked off inside here, and a value area high. I think this may be the highest we probably get on BTC, 17.1 or so. Maybe just the bottom of that, 17.2. That's where we're going to start looking for weakness, because what's happening here? We have a dealing range that was created. There's the buy side, there's the sell side. There's your dealing range. You agree? So let me show it to you like this. The top of this range to the bottom of the range, that's your dealing range. We want to get to 50%. That's what we want. So we want this minimum. That's all that we want. satisfy our retracement conditions, and then send it to hell after that. Because what is this? All of this is distribution. Order flow change bearish, right? It was bearish. They offset their longs, their shorts with longs here into the brick wall. Bearish market structure break, right? Distribution again in here. Continuation. So that's what's going to happen. Whether you like it or not, that's what's going to happen. Can you see how the small or the minor details now, like knowing that this is a balanced price range in here based on the fact that all of this PA was in here, even though there's a fair value gap here, it means nothing to us. What happened in here was also a balanced price range, which makes this a brick wall, this a balanced price range, and it means that BTC never has to, oh, if this wasn't BTC, price never has to come back to that range because it's already a balanced price range. So expectations that price can come up here, it can, but highly unlikely. What we'd start to do then, we'd start to use our projection fibs from the, let's call it the entire series of up candles here. Top of the, to the bottom. Project it down. Targets would be 3.5 minimum, 13,051, 12,503, and 10,530. Those would be our targets to the downside. Remember that reversals seek liquidity pools. Where's the liquidity pools? Even though I've marked this as some sort of order block, this order block means nothing in a bearish market. You understand that? Bullish order blocks mean nothing in a bearish market. Does that make sense? So if you think, if this was a bullish market, then a bullish order block would make sense to me. In a bearish market, this bullish order block is liquidity. It's going to fuck straight through this thing. And this. And probably at some point come down to COVID lows or lower. There's a whole lot of shit happening down here. So they need to look for liquidity pools to reverse from. You may get a situation where they may take this one, then start to do something like that, get people bullish again, and then do that. Right? You see it? So for now, I'm not bullish. Brick wall above us on BTC, act accordingly. And whatever happens on the low time frames, even on the lower time frame here, let's look at this, right? I had this marked off. You can see price came back into it perfectly and moved away from there. All it was a candle, again the candle that broke through highs over here, left a fair value gap, price returned to it, tapped into it, and continued up. If you look at an even higher time frame, let me get rid of the volume profile indicators, because you guys don't need that now. Right, same story here for our, so whatever I told you here is all you're going to need here, right? So there's our range. What is our range? Our range is here to here. You agree? That's our range. Now, the only thing I don't like about that is, but it may not happen now, is they may want to run the low of the range and then run it up, right? But we'll continue monitoring this one to see if there's any market structure shift bearishly for that to happen. Ideally, you want them to run above the range. There's your FEG here that we are interested in, which coincides with the zoom candle. I've got it marked off here as a zoom candle. You guys can see that. Again, accumulation, failure swing, open liquidity run, push, retrace, continuation. Simple.
Yeah, because we've got a smaller market structure shift there on Bitcoin, right?
Yeah,
right
in here.
at the end. So tracing into the FEG and moving
Yeah,
seems to. This is what I used for Apple, right? We had
yeah,
two bullish market structure shifts in a row, right? One on a
yep,
higher time frame, one on a lower time frame. And I entered on the second one.
yep.
So yeah, let's see. I'm not really interested in playing Bitcoin, honestly.
I'm
I
not
think there'll be
interested in
enough
now.
stocks.
I'm not interested in longs, to be honest. If it comes up here, I'm gonna look for something here, because I guarantee you I can find a market structure shift up here that would, because we've got all the good bits in here. We've got zoom candle, we've got FEG. Let's just take a look at this really quickly. Right, anything above there, so I'm anything above 17,297, I'm a seller. In actual fact, it doesn't even have to be higher than that, because you've got an FEG at the 50%. So anything even slightly below that, I'm a buyer. So above this seller, sorry, above this red line range high, I can be a seller inside there on a market structure shift. What we also have, and what we noticed, was when I had the volume profile indicators, is that this is the volume area high here, all here. All of this was deviation. If I can put that back on, what that would look like is, in fact, I don't need to do that. I need to SVP. Nope. Visible range volume profile on a weekly fixed range volume profile. Right, let's look at it. Let's look at this one to there. Let's look at that to that. Let's see what that gives us. Right, gives us here. Now if I went further back, you would see that this area here is a volume area high. So whatever, anything above this is, let's call it manipulated. There's no liquidity left there. So ideally I don't want it to come back up there. I'm not interested in, if it does go above here and then give me a market structure shift, yeah, I'll be a seller there, but I'm not interested in buying BTC, to be honest. Same with Ethereum. Let's get rid of all of this. It's all the same, right? It's all the same. Let's look at Ethereum here, right? Really quickly. Fair value gap here. Zoom into that. Right, from the candle that broke through a high, what happens? Price taps into it, price taps into it, price taps into it, and then we get a market structure shift, and then price moves away. Now what's interesting to note is that if you had taken it, your stops would have to be below the low, right? 1150, because if you took this one here, you would have got stopped out twice here if you just put it below this low. So when price came back here, Is there anything you guys can see here that would have given us a market structure shift? What's ugly here is relative equal lows here. So that's going to come back and get taken at some point. There. That'll get taken. Trend line liquidity. Sorry, relative equal lows. Right. We had the down candles here. Which was lower? Are these the same? 11.81.06. 1181.08. Sorry, so this one to the left was lower. Market structure shift. FVGs. Pretty shitty PA inside here, huh? But you could have got something here. Let's have a look here. Here's another market structure shift there. Here are the candles that broke through a high. There's it here. Did it tap? Didn't tap. So most likely this retraces and comes back into here. It left too many relative equal lows and all of this liquidity in here, to be honest with you. So I won't be surprised this week we'll see this. Now let's talk about why we'd see this before we see this, right? We said the same thing for Apple. Let's go to the indices because I know some of you guys are here for the indices, right? We'll finally get to them. Right. US 100. This is the plan on the US 100 Zoom model. Right. Accumulation, failure swing, open liquidity run. Now, I want to see this push down here that takes the failure swing low. We haven't had that yet. Once we have that, then I'll look for the retrace in here. And let's talk about where and why. Right, failure swing low. Let me take away all of these captions now because you are familiar with them. Right. Here's a fair value gap here on a daily. I can probably there, right? It was a candle that broke through a low that left a fair value gap behind. Only sell side was offered, no buy side, which means when price returns to it, there are going to be willing buyers above the market price, which is here, willing buyers here. So if we start to long here or buy it up, these people will have someone to sell it to. Couple that with the Zoom candle, two red lines that I have here. Put together value area high on the volume is also in here. This is going to be an area for selling. 11.6, 11.5, between 11.450 and 11.6 is going to be an area for selling, right? Now, let's talk about Friday. On Friday, I took a short here. Let's look at it. Now we had what seemingly looks like a Zoom model happening inside here, right? But I'm not too impressed with all of this here because it's higher lows, lower highs and lower lows. You see that? So I'm not interested in a bullish reversal until, remember I said here, there is the failure swing low is here. we also have what I call here a 10 a.m. unfilled price. Now, in my rebalancing model, which I'm not going to go into that now, I'll go into that another day, right? That's too much to handle now. There are certain times of the day that the price is sensitive to, right? 7:15, 8:20, 7:20, 8:15, market or New York, London, Asia. There's certain times in the day and in every 3 hour cycle that price is sensitive to. This is one of them, right? Just take it for granted. This is one of them. Price is drawn to it like a magnet. So for tomorrow, what I do want to see is I want to see, like we said for Apple, like we said probably for Ethereum, I want to see price pull downward here. Take the failure swing low, which is this low here, of this entire structure here, to confirm for us that we are even more bearish overall, right? So accumulation, failure swing, open liquidity run. Once we take the failure swing low, then we've created the dealing range. Then we can retrace. See that? Retrace there. We've taken liquidity, so we're allowed to reverse. We can't reverse if we haven't taken liquidity. That's what reversals look for. I said that just now earlier. Reversals look for liquidity pools. Retracements look for imbalances. So these are all retracements inside here. Reversal, if we get this push down here, I'd look for a reversal. Most likely we have a bearish, may have a bearish week, and then the following week we start getting a bit more bullish. But if tomorrow is Tuesday, then by Wednesday or so, right? Let's see if we can hit the low by Wednesday and then start pushing up. But what is that again? That is, order flow is bearish and has been bearish all here. All of this is distribution. The people here are offsetting their shorts here. So when they pull back like this, or like this, or like this, all that they're doing is buying them back lower to run it back up so they can sell, right? So they're accumulating sell side to offer it to buy side. People who are willing to buy above market price, that's going to be inside here. So that's where I want to see run the low here, 10.6, then reverse and start sending it up to 11.6. So that's about $1,000 move there. And again, there's a lot of confluence in here. Value area high in blue, breaker block, fair value for selling FEG, right? All of that besides the head and shoulders meme. And finally, zoom model. Makes sense. So run lower Monday, Tuesday, or Tuesday, Wednesday, and then Wednesday makes the low of the week, and then we start heading higher. Now, I was short here. Let's go on 1 minute. I was short here on Friday. Here. Is it a 5 minute? I can't even remember. Hold on. Where was I short? I'm sure it was there. Yeah, it was up here, right? Here. No. Here, sorry. So we had the market structure shift happen inside here. It happened here. Broke above that. So I was looking for pullbacks. Price started to run away here, but I knew there were relative equal lows, and there were, especially here. Down here, there was relative equal lows that needed to come out of the market as liquidity before price ran up. Now I was short up here because we had a market structure shift, Right, market structure shift in here. There's your FEG that led to the market structure shift. I was short inside this FEG here. And what they did, they ran down, three-wave move to the downside. This is served as inducement. They pushed price up, took the liquidity, didn't take the high, and then they ran it down. Ran it down where? Let's mark it off for you. Here. Relative equal lows. Can you see that? I was long inside this down candle here. As soon as it hit this relative equal lows, I longed it immediately. Now my stop was below here. Right, it was about a $30 stop, which I was willing to take, but more importantly, it was this FEG here, right? So if retracement seek imbalance, then that's what we were looking for. If you had waited, then you would have gotten, probably look for another entry in here. Again, market structure shift, all of that story inside here. You could have caught something inside here. You could have gotten something here. I mean, you could have even gotten something in here, right? There. If you didn't wait for that one, you could have gotten this one. Right? Now, look what happened in the afternoon. I was long at the bottom here.
Yeah.
And I'm just going to put these two things on. I said I wouldn't show it to you, but I'll show it to you now quickly. We had a level of price here that was sensitive and was not filled. It was all the way up here. It was 4 p.m. The previous day's 4 p.m. price here. Right? So 4 p.m. opened up here and 4 a.m. opened up here, which led, now if you guys remember from last year, 4 p.m. from a previous day to 4 a.m. the next day, if 4 a.m. opens lower or higher, whatever the gap between is a void to me. It's not real price action, which means all of this here did not exist. All of this price action did not exist. And if that didn't exist, and we didn't quite fill it here to here, but we went down lower, it means that this needed to be filled. So when I took my long here, my exit was at 4 p.m. price fill there. Where did it go to? Now watch this carefully. I'm going to take this off again. It went to FEGs above here. So it went to a PD array above here. Let's mark that off if we can. There. That's where it is. It's just an FEG above current FEG. It's an FEG that led to the market structure shift. It's the same FEG we speak about here when I say this was the candle that broke through the series of lows here. Price is now pulling back into it. Let's call it there and there. What do you think we need to do here come tomorrow? We need to look for the market structure shift. Once we find the market structure shift, we are going to short it down. Short it down all the way down here. So that is a $400 move. That's what we're looking for tomorrow, between tomorrow and Wednesday. Makes sense? After I've told you all that I've told you, if this is a retracement, it should not go higher than these highs. Which means by tomorrow I want to see it, which technically it already has. So by tonight, if it does something, there's your market structure shift. There's the candle here that was breaking through lows. If we went even lower, we could use this as an FEG, but I want to see it push up maybe just one more and then give us a proper market structure shift. But here's an FEG inside here that we could use, right? So let's see how tonight opens. Get a market structure shift. We want to be short and send price down. Same story across all indices, all of it. You see how so this is why it may push higher tomorrow slot. There's a 10 a.m. unfold price here, so that is what, $6 more, 39 to 47, about 7 and 1, $8 more, right? So small push up.
Let me take profit and then I'll buy back lower.
Yeah,
give me one more push.
yeah, small push up. There's a 10 a.m. price here. Technically it was full, but it would serve as support and resistance, right? We could look at this fair value gap or the actual gap itself, or this fair value gap inside here, there, right? Then market structure shift, and then let's talk about something else that we look at, right? Every day I have three things opened up here. It is there, right? I have the S&P in big because this is my main chart. We put in the US 30, and here we put in NAS, right? US 100. We keep them all on the same time frame, and we wait for the magic to happen here, which means let's have a look here. Lower low, right? Did I get that right? Right, watch this now. We want to trade the strongest pair between the three. We look for what I've been telling you is SMT divergence, right? Between these three, there's going to be one or two that are going to do something different to the other one. Here we had lower lows being made. Same time frames now, right? So you can see the cursor is the same on all three. Here we had lower lows right there. So these went lower. Here on NAS you had a higher low. This is what is called SMT divergence, which means they are building a long book. They are offsetting their shorts below lows to send it higher. And NAS in this particular case was the one that showed the unwillingness to go lower. So once you see this SMT divergence, you're gonna think, hey, wait a minute, these fuckers are building a long book. They want price to go higher because two of them went lower, but one of them didn't. I'm gonna trade the NAS pair in this case because it's the strongest to the upside. Willingness to not go lower or unwillingness to go lower means that this will be the strongest pair to take higher. Does that make sense? Between the three, this is the strongest to long. So that's what we do. You can go back and look at every single piece of price action every day and see the SMT divergence being formed. Let's have a look here if we can find anything else for you. All right, open up any particular time frame. Let's look here. Right. Oh, this has a gap here, so it's not really helpful. But what you're going to notice, let's go back a bit. let's see, this one here is way here. Just give me a second, guys. That top there, right? Perfect. Let's look at it this way. Once you start looking at things at the top, right, you can see that these two went higher, but NAS didn't make a higher high. So NAS in particular showed an unwillingness to go higher, which means these guys were building a short order book. NAS would be the one to short. See that? Take it all the way down. You could short any of the other two if you found a model within them and a low to take it to. They all went down, right? But you often find times where one is going up and while one is going down, like NAS is going down while US30 is going up. So we take the strongest pair in the direction that we want. In this case, NAS showed an unwillingness to go higher, so they're building a short book. We short NAS and we take it down. Simple as that. Every day, just look for between the three at particular times and highs and lows. Look for SMT divergence and take the one that's stronger. Right. Anything else, gentlemen? This is all being recorded, by the way. So we've done.
You don't need to do this now, Poison, but at some point, because we have a few days. But
Yep.
I'd like to see Tesla, if there's a chance you could see it going to 165 to 170. We've got a gap up there because that's going to be a bigger short than I think Apple would be.
We can do it now. We can do it now.
Okay.
Right. What are we talking? 160. We've already marked that off.
Yeah, I just don't know if there's one in the 140s too that I think I could
It's,
see it too, but I think there's a bigger one there up higher.
So balanced price range all up in here, except the 160. So here, if it shows willingness to go there like Apple is for retracing, then I think it doesn't have to go to 190s or 166-ish. 160 should be okay. That's okay. 166, 167. I take that. All of this is balanced in here because of the price action. And if you look here, this was all down candles here, so only sell side offered there. So if you get a market structure shift, which it looks like you're sort of getting, but we'll have to go low time frame to figure that one out as well. Pretty shitty candles. Right, so hold on.
Yeah, this is your island reversal, right?
Yeah.
Gap down, gap up.
Yep. Right. We'd have to go even lower on this, but what I don't like is just all the gaps in these candles. But yeah, so if we can come back down, let's look at this particular candle. You see this one? What did it do? You see that candle that I'm talking about there? It's, if you understand how the candles work, then that particular candle traded through all of this, right? Even though it retraced like that, but the fact that it traded through all of this confirmed the OB here. But what did it do before that? It went through the low. So what did that give us here?
Dealing range.
Dealing range, which means we only had to use a fib tool here, retrace, and take anything below the 50%. Because that candle, this candle did that.
Yeah, if you zoom out on the weekly and you go back like 2 years, there's it's a big liquidity sweep down there too. So a big move up to 160 wouldn't
Yeah,
surprise me at this
so
point.
a move up wouldn't surprise me because we've taken liquidity. We've got a longish wick here, so a move back up into these levels here. Let's try, and the market likes to do shit like this, so let's make it the top of that as well, right? Anything above here is sort of balanced, you can see, but this candle broke through the low, so we'd call it there to there on a weekly and there. So if they are now distributing, we'll take it up to here. Yeah, sure. Take it up to there and send it to shit. It's a balanced price range above there. It's a brick wall. All of that story.
I like it. I'd rather take that short than Apple, honestly. So
Yeah. Well, let's see if we can get up here, because if you look, technically, this is also a balanced price range because you had a fair value gap in here. You see that? Price traded up, then price came back down, traded through, came back down. So technically, anything above this candle is balanced. Ooh, so now we have to see whether we do in fact have the willingness to go higher than maybe just this candle's higher.
yeah, and that's why I was thinking mid 140s was why I
Yeah,
wasn't
so
sure if we
somewhere
could
here,
get past that.
154-ish,
Okay.
153, somewhere there. There's an order block in there as well, so yeah. But again, obviously, they want to offload to at fair value gaps where there's liquidity, but it doesn't mean that they have to completely fill this. That means they just have to go above this guy here, there, 160.
Yeah, and we can just watch the NAS, right? It'll move
Yeah.
with the NAS.
Yeah,
So
so
when
retrace
the
and
NAS
then
starts
move
up,
up and then come down, yeah. Let's have a look. Yeah, anything else? Gold, what is gold doing? Gold doing all sorts of naughty things, right? But it's sort of in a dealing range. I don't like it, but it's there. Buy side taken, sell side taken. So I'm thinking if we get a market structure shift on gold, NAS goes up, gold goes down, then this is a 15-minute. Let's look at something higher, maybe lower, 5-minute. Yeah, so take this across in time. If we can get back to sort of this level would be good. There. Right, now time to look for market structure shift and all of those good things. Not seeing anything here because it took the high but didn't take any low. Gold likes to do stupid things like this, and then this, then something like this, and then this. So we'll have to watch for that. No clear dealing range here at the moment. But we're in the area where gold needs to, or can be sold. So all eyes on these, whatever these candles open up. Say this one, so say this candle here, we didn't get a market structure shift, although we got the OB validated here. We only get a market structure shift on a 5-minute. There is no fair value gap, so only once we trade through there would we consider that to be a market structure shift. We'd watch the candles that form here and here, whether they do leave this as a fair value gap inside here. So if we get something like that and then a retrace in here, yep, you can sell there, take it down. Where are you taking it down? you want to distribute it at the lows, so all the way down here. Right, all the way down here. Yeah, that's it. Anything else in particular, boys? The model, the main concern for me today was the two models, right? Once you understand that, you don't need me. You can start to see this all by yourself. Let's have a look here. Telegram. Live streaming. Al dente, you good there? Or is that Black Swan?
Poison. Do you mind doing GBP JPY once you're done?
GBP JPY, no problem. Is that Mick?
Yeah.
Tell me what you're seeing, Mickey.
So to my understanding, I was actually wanting to go further down lower into the 155 region as confirmation to want to go up, because we still have that fair value gap that we just stepped into.
Yeah.
But there's still a lot of imbalance on the lower time frame.
When you say lower time frame, which time frame are you talking about?
Say about the 15-30 minute.
Yeah, let's look at a H1 and then so we'll start on a H4, H1, and then we start to refine the levels as you get lower and lower, right? So there's imbalance down here. You're right about that. Not completely filled. This candle was too long down here. This entire series of candle was an order block, but this was the entry. This was the entry candle on the ICT model, right? The one I just showed you now. So if price comes back here, then yeah, it's 152-ish, 153-ish.
We're looking to buy that.
Yeah, we can buy that, not blindly. We buy that on confirmation, right?
Correct.
Now, what happened up here? We had sell side taken, right? Then it ran and took buy side. So that makes this to this the dealing range. So if this is the retracement, our stops have to be below there firmly. We know if anything below that, we're wrong. So now we are looking for opportunities for GBP JPY to head down lower. Let's look at the candles that rebalanced an FEG there, and this was another entry point here, right? I had it marked off just now. This is also another entry point in here forming. So now, two things. If we don't head down lower, you want to be looking for market structure shifts that happen in here, right? And if you get a zoom model forming in here, then it's going to become an entry for you, because there's some small imbalances down here. I don't know if it comes down here, but here it's looking balanced. So if we start to see market structure shifting like that, then you've got your zoom model building here, right? Then you take it there and then you write it up, because we know this wants to go higher because it made a bullish dealing range. So just wait for the market structure shifts to happen and time it with Tuesday to Wednesday. So if we look at this being every day, what I do is I take from, let's go on a 1 hour. On a London session, I take from 2 to 5 a.m. I mark it off with a time box, right? 2 to 5. 2 to 5 a.m. get in there. 15 minutes. Maybe too far back. Right, let's look here. So in London, every day I'm marking, we can take it on a week. Let's look at a week. Instead of me showing you a mini week, let me show you an actual week. And any week we could take let's take this week here. So this particular week here, we had, this is Monday, this is Tuesday, this is Wednesday, Thursday, and Friday, right? Now watch this. In this particular profile, when Wednesday makes the high of the week, it also makes the dealing range. So there, buy side taken, sell side taken here. You ideally we would have wanted to see, but like I said, it's the time of the year where these don't really play to rules. But if Wednesday is the high of the week, Thursday to Friday caps the week. So if Wednesday is a high, Thursday to Friday is the low. I'm going to start showing you more of this this coming week going into this, because we could apply this to a 3-month candle, for example. If this was the 3-month candle and we came down to a 1 hour, where are we, which day of the week are we in on a 3-month candle, right? Okay, wrong 3-month candle to take. Let's take the one before that. So this will give us an idea overall where we expect price to go to. Let's go there. Right. Look at this 3-month candle here, right? I'm only interested in 3 profiles mainly. My first profile is Monday makes the high or the low of the week. So if Monday makes the high or low of the week, Tuesday retraces, Wednesday comes and takes Tuesday's high, and Thursday continues. That's a Monday profile. I'll give this to you. Tuesday makes the high of the week, so Monday goes sideways. Tuesday makes the high of the week, creates the dealing range. Wednesday retraces, Thursday continues. This is a Tuesday profile. And Wednesday makes the high of the week, creates the dealing range, retraces, continues on Thursday. This is a Wednesday profile. So here, if this was Monday, Tuesday created the high of the week. See this little, let me show this to you here. Tuesday created the high of the week and the dealing range, but it made this little jobby here. Wednesday retraces, and usually it comes for here, right? You can see here. And then what happens next? Continuation down. So let's go back to our model that we did. This is Monday. Tuesday creates the high of the week. Tuesday will create a little retracement. Wednesday comes and takes it, or Thursday, and then we get continuation, right? You see that? Can you see that happening here, how that happened here? Pull it back.
68.
Yeah, pull it back to the profile for Tuesday. Tuesday creates there, retraces and comes down, or even a Monday profile. Wednesday, if Tuesday and Monday, well, if Tuesday creates the high of the week, Wednesday almost always comes back and takes that middle inducement leg before continuing lower. So we're only interested, I'm going to post this in the Telegram and I've got it in the Discord. the three profiles that we're only interested in. So on this particular day, well, not day, at this particular point here, which was the beginning of December, we could say that we expected this to go down based on the fact that October created the high, which was our Tuesday. November into December retraced, and December coming into January continued. Can you see that?
Clear.
And
So would you, that leg that it might, is that not the first leg of distribution that it might?
which leg is that?
The long,
This. Yeah, it's
It-
distribution here. First leg. We could come here, we could call this the second leg. Or it could
That's
do
what I
this.
was thinking.
Yeah. But if we are overall, we're on a daily here now, right? It created a range. If this is a bullish range, then we don't expect it to take the lows because retracements are only seeking imbalances. So we'll seek imbalances in here and anything lower. And then we'll look to market structure shift and create a new Monday, Tuesday of the quarter. Whatever that does, right? Like that. You see what I'm getting at? So if we use this on a higher time frame, we can get even longer plays. Because if you knew at the beginning of December, it was your Thursday. That means you expect Friday to continue, going into Friday to continue. You could have taken a short there. Look at that. 169 to all the way down here. You can use this profile on anything, but what I mainly use it on is every day. If you go take it from 2 to 5 a.m. for the London session, or you take it from 4 a.m. to 4 p.m., which is the New York session times that we use, 4 a.m. to 4 p.m. Right? This is Monday. This is 4 a.m. Yeah. This is Tuesday. Wednesday retraced. Thursday into Friday continues, right? Can you see that? So Monday made the high of the week. There's your dealing range now being created. Wednesday retraced to above Tuesday there. Can you see that? Thursday and Friday continued. So if you just know the three profiles, but you don't have to learn it, I'm going to give it to you in the you specifically, Mickey, and you can send it to the rest of the guys. Three profiles, and you just need to know which one of the three profiles are being made. Because what we're doing on a daily, on a 3 month, on a yearly, you can be doing on a 5 minute. Where each 3 hour cycle is a Monday, Tuesday. So if this is 8 o'clock in the morning to 11 o'clock cycle, the first 2 minute candle, this is Monday, Tuesday. This is Monday, Tuesday. Wednesday created the high of the week. Retraced, pullback, gone. You can do that on a 5 minute, you can do that on a 1 minute, you can do the same thing on every candle. So in the next 2 weeks, we'll incorporate these ones, again, the CSD times, the change in the state of delivery. Because if you go and input this into, let's say, S&P, where was our S&P model here? Right, let's look here. Do I have my CSD? Right. Look at the change in the state of delivery time and what happens there. At 15:15 you had a change in the state of delivery. Price came back. So this was the last 1 hour and 15 minutes of the market. Price came back into an FEG, took off. Look at this profile. Gray boxes are Monday and Tuesday. So Monday, Tuesday, Wednesday created the high, Thursday into Friday continue. Monday created the low, Wednesday retraced, continue. So you can do this every day, and you don't need, you can do this And every 3-hour cycle here. Look at this one. Monday created the high. Tuesday retraced. Wednesday came and took the inducement there. And look at that. Continued there. Can you see where I'm getting with this and how you can start to use it? This is on a 3-hour cycle now. So if you know what's going on here, you know what's going to happen next. Monday, that is why they say Wednesday is the real start of the trading week. Because you allow Monday and Tuesday to create the range, Wednesday to do its thing and carry on. So if this, look here, Monday, Tuesday, Wednesday retraces, takes the liquidity, gone. You see that? Right, anything else, boys? I think we'll be rounding up now. I'll post this on YouTube. But like I said, the main purpose of this particular market analysis or Zoom live was to just do the 2 FEG models that we spoke about. Just with that alone, you would need nothing else. Because once we start to get more into all of these times, it all becomes one big model, because you're going to start to see the Zoom models form within this. So there's here, there's the liquidity run, there's the push, there's the retrace, there's the continuation. That's how I want you to start seeing all of this incorporated with days of the week and times in a day. Certain times things happen. You just need to be aware of what those times are, and then we take them accordingly. Because all of these boxes, like I said before, serve as a drawn liquidity. So when you had all of these boxes being created here, whose lows have not been taken, all the gray boxes down here, whose lows have not been taken, when this starts to go, it's going to take all of this here. So now we're starting to build an entire model based on Zoom, based on ICT's fair value gap. We incorporate days of the week, and we incorporate 3-hour cycles with the change in the state of delivery. Right, we'll build on that in the next 2 weeks. Those, I think, are about all that you would need to trade profitably every day. All it would require is for you to read up or learn or understand what a fair value gap is, what balanced price ranges are, just the small stuff, just the terminologies, right? Right, that's it. Thank you, boys.
Thank you. See you next time.
Cheers.